welcome back to Wealth Doctor TV. If you are new to my channel, click the subscribe button below to become part of the family. And if you are a returning subscriber, thank you so much for your love and your support. So welcome to episode 2 of the investment series. So I'm doing a plus or minus 10-week investment series on my channel where we'll be unpacking investing and the different types of investing and going into them into detail, because why? This is Wealth School. I want to educate you on how to make money, and investing is a very, 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 very huge part of you building your wealth, which is why it's essential for you to understand, which is why I am taking my time 10 weeks to explain all of this to you. And for this investment series, only for this series, we'll be posting wealth or personal finance related videos every Monday and Thursday. Today we'll be talking about investing in shares or investing in the stock market. I know many of you have been waiting for this video and it's finally here. So what is investing in shares? Investing in shares, it means you are buying part of the ownership of a company. So if you have shares of a certain company, or if you're planning on acquiring shares for a certain company, you are or you will be an owner of that company, right? So how does it actually work? So for an example, if a company needs funding to expand their business or whatever, they will do an initial public offering where they issue their shares to the public so that the public can buy their shares in exchange of ownership of the business. So when the people buy the shares, they now become shareholders of the company, meaning that they are sharing the ownership together with the people who started the company or who issued the shares to the public. So for example, to explain or to make it understandable for you, let's say Letty has a farm, has an avocado farm, and she would like to expand her farm in the form of buying equipment for the farm, buying more land so that they can make more profit. So Letty now needs 100,000 rands. So she issues 10,000 shares, of which she issues one share, 10,000 shares at 10 rands each. So a person who's going to buy one share of the farm means that that person owns 0.1% of the farm. And then if you buy more shares, you own more in the company. So if you buy 10% of the shares, it means 10% worth of the shares. It means that you own 10% of the farm. So now, how do you make money from investing in shares? Because obviously you can't just give other people your money and not expect to receive anything in return, especially if they want to use it to expand their business. You can't just expand someone's business for free. So how do you then make money from investing in shares? So now, when you buy shares, you receive a certificate that you are now the owner of whatever company that you bought shares in. Does not matter if your ownership is 0.0000001%, for the fact that you bought shares, regardless of whatever percentage you hold in the company, you are given a certificate to show that, okay, girl, you are the new shareholder of this business and you own this much, or you own this much shares or in the business, right? So it doesn't matter if your ownership in the particular company is a small percentage, as long as you put your money in that company. Even if it was 10 rands, you still own that share, that 0.00000 is yours, and you deserve to get a certificate. Now, because you are an owner of the business, it means that you have to benefit from the growth and the profits that the business will make. So those are the two ways that you are going to make money from the business that you are investing in, right? So the first way is capital growth. So what happens is, you remember Letty needed 100,000 to expand her farm. So let's say people bought all of the 10,000 shares that she issued, and then she used that money to expand her farm. She bought tractors, she hired more people, and they grew more avocado trees, right? So now, because there's more avocado trees, there's more what is this, equipment and everything, it means now that the farm is worth more than the 100,000 that she needed in the beginning. So let's say that the farm value grows from 100,000 to 1 million. So since you bought the shares at 10 rands each and the value grew to 1 million overall, it means that now each share, because we have 10,000 shares, it means that now each share is worth 100 rands, meaning that you made a capital growth of 90,000 rands. Or another example, because you are the owner of the business, you suffer in both the gains and the losses. So let's say maybe Letty also borrowed this 100,000 rands from people, and you bought your shares at 10 rands per share, and she goes and invests the money, and then you find that the tractors that she bought were not of a good quality. The land where she was planting the avocados was not fertile enough, and nothing, there's no growth, there's no profit, there's nothing. The tractors break down. So the farm now loses value from 100,000 to 50,000 rands. So this now means that her shares are now worth 5 rand each. So if you bought one share for 10 rands, then it means that now your share will be worth 5 rands. So it means you made a capital loss of 5 rands. However, you only realize a loss if you sell your shares. So if you haven't sold your shares, it does not mean that you made a loss. It just means that your investment dropped in value. And remember, since buying shares is a long-term investment and is a very volatile, so volatile just means it moves up and down frequently. So it's a very volatile investment. It means that your investments are going to drop and go up, drop and go up. But in the long term, you find that your graph grows exponentially, meaning in as much as it was going up and down, overall, you made a profit. So you only realize a profit if you sell. So if the shares drop to 5 rands and you sell them, then you made a profit. But if the shares drop to 5 rand and you don't sell them, you just leave them in the portfolio and you wait, and then maybe after 10 years or after 5 years or after 3 years, the lady now manages to boost her farm, and now the farm grow again to 1 million rands. Then it means that you made a profit, but also you made a profit if you sell them. Because in as much as they grew in value and you don't share them, you're not going to get the money up until you share them. You get what I mean? So don't be stressed when you see your share price fluctuating. That's how shares operate, because businesses are unpredictable, and you buying shares is you investing in a business. Nobody knows how many people are going to buy today. Nobody knows how many people are going to buy tomorrow. So just keep your cool and just leave your shares there for like 5 to 10 years, and then you see that overall you would have made a growth, or you would have accumulated growth on your investment. And the second type of way that you can make money from investing in shares is through dividends. So like I said, because now you bought these shares of this company, it means you are the owner. So as an owner, you enjoy the profits that you make from your business. So since you own shares, it means that the business is also yours, and you also deserve to enjoy the profits of this business. So let's say now you bought 1,000 shares in the farm, and there are 10,000 shares in that farm. And then for the year 2021, the business now makes a profit of 50,000 rands. So the board of directors is going to decide if they're going to issue all of the profits as dividends, or they're going to issue part of the profits as dividends. It is not your decision as a shareholder. Unfortunately, it's the board of directors that decides how much you're going to get, and obviously they're going to take the profit, divide by the number of shares that are there, and then they distribute the profits or the dividends according to the number of shares that you own. And you need to keep in mind that there is companies that do not pay dividends at all, and it's your responsibility to do research before investing in a certain company, whether you are okay with not being paid dividends or you mind not being paid dividends. And obviously, if you mind, then it means you cannot invest in that company because it's not going to suit your goals. Going back to my first video where I said that you need to invest according to your goals and not because you saw your friend. Because your friend might invest in a company that does not pay dividends, but they know why they're investing in that company. And if you don't focus on your goals and your own investment strategy, you're just going to put money there, and then the next thing you're surprised when you don't get paid dividends. So do your research before you invest your money, especially if you want to get dividends. Another thing about dividends is that if the company makes a loss for that particular year, you get a zero dividend. So you don't get a negative dividend, or they don't ask you to pay extra money. It's just a zero. You don't get anything, right? Another thing when it comes to dividends is, remember I said the two different ways you can make money from shares is capital appreciation and dividends. Another thing is, sometimes you might find that the value of the company that you invested in fell, but you would find that you're going to still receive dividends regardless of whether the value of the shares fell or it appreciated. So if your company pays dividends and it's making a profit, whether the value is at a positive or a negative, you are still going to receive your dividends. So the fluctuation of prices does not affect your potential of earning dividends. You will still earn your dividends in as much as the price is still going to fluctuate. And the different ways that you can invest in shares is, first one is you can buy individual shares from your stockbrokers. And the stockbrokers that are there in South Africa, we have your Easy Equities, you have Standard Bank, you have ABSA, your Net Group. There's a lot. You just have to do your research and see which one is most suitable for your needs and your goals. However, Easy Equities is the most affordable one because they charge a very small percentage of brokerage fees, because you pay fees when you invest in shares through a stockbroker. The second way you can invest in shares is through buying an exchange traded fund or an ETF. So what an ETF is that it's a collection of different types of shares into one basket. So I'm just gonna show you an example. So what an ETF is this is your ETF, and maybe this is a property ETF, or it's a top 40 ETF. So if it's the top 40 ETF, it means it's going to have all the shares that fall under the top 40 in one basket or ETF. So now investing in ETFs is good because if you cannot afford to buy shares individually, for example, let's say maybe a share of a particular company is 1,000 rand and you would like to own all of the shares in the top 40 companies, how then can you do that in an affordable way? Because you cannot afford to buy them individually. Let's say I'm not saying they're not. Let's say all the shares in the top 40 are 2,000 rands. So it means you're going to say 2,000 rands times 40. That's a lot of money, and not all of us have a lot of money to invest. But ETFs give you the opportunity to be able to buy all of the top 40 shares in one basket, and they charge a very small amount of money for that. Right? So that is the second way of doing it. I'll do a separate video where I explain ETFs in detail and how they work. But all you need to know is that an ETF is a basket of different types of shares or different types of bonds. And ETFs are normally suitable for a long-term investment. Why? Because they trade like shares and you can buy them in the stock market through a stockbroker. And remember, I said your stockbrokers is your Easy Equities, it's your Net Group, your ABSA, your Standard Bank, your PSG. Depending on what you are comfortable with, then you can go do your research and see which stockbroker you want to work with. And then the third way you can invest in shares is by buying a unit trust. So now a unit trust is also almost similar to an ETF. So it's also a basket. And then in that basket, you can buy a lot of securities and put them at an affordable price as well. So how does how does a unit trust differ from an ETF? Is that an ETF, it trades in the stock market and you can buy it from a stockbroker, and a unit trust, you can buy it from a unit trust manager. and this one is managed, and the other one, the ETF, tracks an index. So another difference is with a unit trust, you can have your shares, your bonds, and your cash in one unit trust, but in an ETF it's very unlikely to find your shares and your thingies in one basket because it's a long-term investment. We do have bond ETFs and equity ETFs, but I never came across a money market ETF or an ETF that is diversified into equities, medium and short-term investments, or equities, bonds, and money market securities. So the difference between those two is that, and the other difference, that this one is actively managed and the other one is passively managed. But like I said, I will explain how these work in a different video. Now let's refresh on what we were talking about in this video, because it's very important for you to understand how investing in shares work before you go invest in shares. So the first thing is, when you invest in shares, is you buying a portion of a company or a percentage of a company. And the second point is that you become the owner of a company, and you becoming the owner of a company means you get to benefit from the profits, and you also get to suffer from the losses that a company makes. Third point is the two different ways where you can make money through buying shares, which is your capital growth. And your capital growth is pretty much your shares growing in value. So if you bought your share for 100 rands, then it grows to 1,000 rands. It means your shares grew in value, which is capital growth. And the second way you can make money from shares is through dividends, which is you sharing the profits of a business with the other shareholders that bought shares in the business. So if the business got 10,000 rand profit and there is 10 investors in that company, then it means 10,000 divided by 10. It means each shareholder will get 10 rands. But also remember that not all companies pay dividends. And another thing to remember is that the fluctuation in your share price does not affect your potential to earn dividends. So even though your share price is going up and down, or maybe it's currently standing at a negative, it does not mean that you're not going to receive a dividend. The only way you cannot receive a dividend is if the board of directors decides that they're not going to pay dividends, or the company makes a loss. And then the different types of way that you can invest in the stock market is by you buying individual shares through a stockbroker like your Easy Equities, your Net Group, Absa, Standard Bank. And then the second way you can invest in shares is by you buying an exchange traded fund or an ETF, which is a basket of shares in one to make it more affordable for you to be able to acquire shares. And the third way you can invest in shares is by buying a unit trust, which you can buy from asset managers like your Coronation, your Prudential, your Allan Gray, and many more. So those are the things that you need to know about buying shares. And in the next video, which is episode 3 of the investment series, I'll be discussing ETFs and unit trust in more detail. So if you want to understand that, stay tuned. One thing to not forget is you do not need a lot of money to invest. You can invest from as little as 1 rand or even less. If you go on Easy Equities or any other broker, you would find that there are shares that are even less than 1 rand. There are shares for 50 cents. There are shares for 10 cents. There are shares for 1 rand. 0.50 cent. There are shares for 1,000 rand, 400 rand. So you saying that you don't have enough money to invest is definitely an excuse. So you can't tell me that you cannot take out 10 rands to buy 10 shares that are worth 1 rand. Come on. So let's break the myth that shares are expensive. They are not. It's a lie, especially now because we have ETFs and unit trust. I hope that you enjoyed this video, and I'll see you again on episode 3 and for the next coming 10 weeks that we'll be doing this series. Thank you so much for your love and support. Don't forget to follow me on my social media. Is at The Wealth Doctor and at Wealth School with Letty J. If you enjoyed the video and you found it useful, don't forget to like, comment, and share with your families, guys. And if you haven't subscribed already, do you want to miss out on the remaining 9 weeks? Come on. So anyway, thank you so much for watching my video. I really appreciate your love and your support.